Did you talk to Mr. Imo Cole? Now, are you out of intermediate now?
I haven't turned into four yet.
Oh, you're not going to finish intermediate this fall?
No.
Boy, these are those PowerPoints that won't boot up. I need them bad today. See if they're here on these zip. That's not going to work. Just download them partial. Okay, here's the deal on your test. Let me show you the deal that we got here. Okay, here's the grades on the tax test. That's not doubled yet. Might pick up a couple on those fill in the blanks. All right. Now, here are the 5 grades. Hillary, you need to come in and take this test. I haven't heard from you in a couple of days. Hope you're okay. Now, if I multiplied these by 2, the highest grade would be 62. Okay? And there were 3 hard chapters together. So here's what I'm going to do. And that's the only 2 of you here today. So here you need to take the whole test. Matthew, Terry, and Jonathan, you need to give me 45 minutes somewhere to rework this test. Now, the last half an hour today, I'm going to give Cole and Clayton their test back. All right? They're going to have an hour to work on this test. Now, let's say Cole made the 26. He's got 24 he needs to re-answer. And he's not going to mark in that little box. He's going to put the letter out beside of it. Now, Cole, you have 24 you can work on, right? Now, you know you've got an A, B, a C, and a D answer. All right. Now, if you picked A, you know that's not the answer if it's wrong, right? So you've only got 3 choices. So you've got another hour to work on the ones you got wrong, and you've only got 3 choices instead of 4 this time. So I want these grades to be better than this, but I want you to learn a little bit from doing it. So you'll have an hour today. Jonathan, you and Terry and Matthew, try to find me about an hour. I'll give an hour. And Hillary, you need 2 or 3 hours, okay? All right, that's where we are. So I'm not going to go over the test today. All right, we're going to look a little bit at chapter 8. That is your assignment to read chapter 8. Hopefully all of you, Colt, did you turn in your problem the other day? And Clayton, you turned yours in. Jonathan, you still owe me your problem. I think Terry and Matthew may have turned theirs in. That problem still may have to be a bonus on this test. Losses on personal use property are generally not deductible unless they're a casualty loss. We've looked at that a little bit. A 1231 is the character of loss. If it's return or depreciation, it's an ordinary loss. Remember, losses can be realized or recognized. You may have a $50,000 loss. The IRS only let you take 30 of it. Maybe your basis is only 30. You can only take 30. All right, amount realized minus adjusted basis is a gain or loss. We know that. The amount realized is exactly what you sell it for, less any selling expense. Amount realized is cash or any property you received. Deduct selling expenses, of course. Property seized, confiscated, or condemned. I guess you can get your property seized if you got carrying drugs, can't you? I guess you could get your 4-wheeler seized out in the national forest if you were hunting without a license. All right, but condemned is the biggie here. Now, the health department can condemn your house if it's filthy. All right, but condemnation we normally think of. A school district can condemn property to build a new school on, or even a hospital. The state can take your property for a highway, and so on. So your property can be condemned. Now, I think there was a lot of property near a nuclear power plant that was bad. I forget what the name of that was called, but their property was condemned. They had to move. Now, down in Florida and Georgia right now, their property is not condemned, but some of their houses are a total loss, and some of them will have cash losses. Abandoned property. All right, a coal miner. He has $1 million worth of equipment back in that coal mine. He had depreciated $600,000. All right, the mine shuts down. That equipment on his books is still worth $400,000. But he figures it's not worth bringing out. He has to pay to have it brought out. So he abandons that property. And he can have a $400,000 loss because he realized zero out of it. He abandoned it. So it's common, even on some kind of drilling site for gas and oil, for the companies to abandon some of their fixed assets. Now, another situation, if some of our oil companies have property like in Libya, and Libya, we're at war or something with Libya, they've got to abandon, don't they? So that can cause abandonment too if we have property because of war that we have to leave. This is easy enough. My son talked me into buying some penny stock. I believe I bought it for 7 cents a share. And I just bought maybe 10,000 shares. Anyway, I paid $700. All right. Might have been 70 cents a share times 1,000 shares, but it's penny stock. And I have a cousin up in Canton, Ohio. He makes a good living on buying penny stock. He'll buy a lot of stock today at 10 cents a share and sell it tomorrow at 11 cents a share or 12 cents. But in my case, I shouldn't have listened to my son. That stock went down. I believe it was 70 cents. I'm going to make that a decimal times 1,000 shares. It went down, not 70 cents. It went down to about a penny a share. So my investment was worth, what's that, $10? All right. And then it split and it reversed. It sold out to another company. I don't even have enough on the books to sell it to pay the commission. All right. So I wrote off $700 as worthless, as a bad debt. I mean, not a bad debt, but a worthless security. All right. If you demolish structure in order to build a new asset, usually if you buy land for $50,000, it's got a building on it worth 10. All right. So you had to pay 60,000. Let's say you paid 60. Building, land. But you don't need this you don't need this building. You demolish it, tear it down. And whatever it costs you to tear it down, let's say $2,000, just add it onto your basis, you pay for the whole thing. Now you got $62,000 in the land. So whatever it costs you to demolish, just add it on to what's left. We studied this in one chapter, and all capital losses are for AGI. Now, some ordinary losses are an itemized deduction. If they're itemized deduction, they're from AGI. A casualty loss is an itemized deduction from AGI. A capital loss you put on Schedule D for AGI. All right, look at capital versus ordinary. What makes the difference? Has there been a sale or exchange of property? Yes. Is the property held in a T or a B for investment? And what did it say a T or a B was back there at the beginning? If yes, are the properties inventory, notes, accounts receivable, depreciable property? If yes, assets are not capital, no loss is recognized. Now here, or investment, if it's no, loss is ordinary, loss is a capital loss. Okay, and over here, no, has the property been seized or the security become worthless? All right. But let's go back and see if we can see Did they tell us at the beginning what a T or B for a loss to be deducted on T or B or investment? All right, it did not tell us what T or B was. Look at the first of chapter 8. Have you found it, Cole? What do they call them, T or B? Huh?
That's
Okay. For a loss to be deductible on T or B or investment, that may be a business loss. And this may be a personal loss on your taxes. So I don't know what their letters mean in this case. Okay, losses on 1244 stock. That's a small business corporation. They're treated ordinary up to $50,000. Now we know what MFJ is, married, filing, joint. Okay, my brother-in-law went into mining business. He had about $100,000 in stock. The mine went bankrupt. So he took a $50,000 loss the first year, then $3,000 a year until it's all used up. Well, we know a wash sale is disallowed, some passive. We know related parties, we've already looked at that, are disallowed. If you're material to participate, you don't have to worry about the passive. All right, individuals, estates, and trusts are all subject to passive loss rules. We'll have to look at that. This is a personal service corporation, publicly traded partnership, a closely held C corporation. That's a family corporation. We can go back and look at those later. We're going to have to really cover that passive, but there's other things I want to cover first. Cashier theft. All right. We used to say a casualty is an act of God, but we had to get politically correct and say a casualty is an act of nature. Rain, hurricane, tornado, flood, even fire can be an act of nature, or it can be an act of a thief. If somebody steals your property. Okay, Clayton, have you ever lost anything in a casualty? You ever had a car wreck? Ever had anything stolen or anything?
I mean, like little things. Like I ran into a rock one time, like a big, like I just put a scratch on my car. It wasn't like a car wreck, I guess. But I mean, yeah, I have. I have it messed up my car.
Well, if you were filing taxes, that's still a casualty. If you didn't have insurance to fix it, and if you met the other condition, it could still be a casualty. Now, a race car driver cannot take a casualty for a wreck. That's their business, isn't it? But your car, you can take a casualty. You can take a casualty for personal use property. Now, if it's business property, they don't have to take out 100 and they don't have to take out 10%. If you're going to have a casualty, it'd be better for it to be business property. You can take the 100% of it. But in your case, not. theft is larceny, embezzlement, extortion, kidnapping, robbery, blackmail. All right. I think most of our movies anymore, movies are about kidnapping, extortion, robbery, total destruction, part destruction. Now here, do you take fair market value or your adjusted basis? Usually it's your adjusted basis. Cannot deduct the decrease in fair market value. Might have been worth 100. After a flood, it may be only worth 80. But if you only paid 74, you don't have a loss yet. The insurance will reduce the loss. I know somebody came in our house. My deceased wife, she had cancer, and she had Oxycontin. She had 40 milligrams and 20 milligrams. But somebody came in, I don't know how they got in the house, they had a key or what, and it must have been somebody we knew, so they left her some. But when you get pills like that stolen, you can't hardly get them represcribed again. You have to have police reports and everything. We finally got the doctor in the drugstore to give her needed pills. All right. But after that, I don't know if somebody knew the house or not, they came in and stole a lot of her jewelry. Now, luckily, we had each piece of her jewelry insured. So the insurance company paid us back. I don't know if it's fair market value or more than our cost. So we did not have a loss. So if you got insurance, that helps reduce loss. The loss must be reduced as follows. Each event by $100 and total of all net case events by 10%. So in April, you lost $10,000. In September, you lost $5,000. Now it says each event must be reduced by what? We're going to take out 100 for April's loss and 100 for September loss. Now that leaves us 14.8 loss. Now, if our adjusted gross income were 50,000, multiply that by 10%, and that's 5,000. So our loss for itemized deduction would be 9,800. Now that's what we will practice, and we'll practice fair market value versus cost and so on. Now this word seems to be ridiculous, don't it? Did you time when you did your car fitting or whatever, Clayton? Did you time it? You don't, do you? So have you ever had a casting? Nobody's ever told you. Video games? Okay. I just kid Cole about his video. I've got a grandson. He's hooked on them. He is intelligent, but he's making D's in high school because he likes his video game and his girlfriend. So he's got two curses there. Okay. You cannot time, must deduct in year, discover the theft. Now, the theft may have happened in 2018, but if you don't know it until 2019, that's when you take it. may elect to recognize disaster loss in year preceding loss year. President must declare the region a disaster region. All right. May elect to recognize disaster loss in year preceding. Now, I was in tax business, and the county got a big flood. I had all my taxes done that anybody needed done by April 15th. It was about 77 or something. But then a flood came somewhere around, let's say, April the 22nd. All right. A lot of these people that already filed their taxes got flooded out. Now, tax deadline was passed, but it says may elect to recognize a disaster loss in the year preceding. So I had many, many clients to come back, and I redid their taxes after April 22nd. Okay, so I was doing taxes up until June that year. Okay, just personal taxes. Now, these people brought in, they said, I lost my trailer, my mobile home, it's all gone. I had to give them a booklet furnished by IRS, and they had to list everything in their bedroom, bathroom, living room, kitchen, dining room that they lost. If it were a home, there may be a basement, there may be more bedrooms, whatever room's in the house, garage, they had to list what was in it. Now, if you ever own a home, guys, and two ladies out there somewhere, take your camera, take a video of everything in that bedroom and living room and kitchen and dining room. If you ever have a casualty loss, it's good for that video is good for two things. One is to show your insurance company to get reimbursed, and two is to show IRS if you have extra casualty beyond the insurance. So for IRS and insurance, take a video of your house inside, everything. All right, we know that insurance reduces loss. Bad debts. Clayton, what do you do about bad debts in accounting? Do you remember bad debts? Okay, you're an intermediate now, Clayton. Have you had bad debts yet? Don't think so. Well, in principles, you had bad debts. Now, do any of you remember what two methods we used in principles? We used what was called a direct write-off method. Direct write-off method. And then we use allowance method, right? Now, allowance method was an adjusted entry on the accrual basis of accounting. You can debit bad debt expense and credit allowance for doubtful accounts or allowance for bad debts or allowance for uncollectible, whatever you call it, same thing. All right, IRS does not accept the accrual basis of accounting. IRS don't let you take a bad debt till it's bad. The direct write-off method. When it's bad, and you write it off. Credit, debit, guarantor. All right, now if you loan $10,000 to someone and you don't get paid back, you know the base is $10,000, right? It gets down to property or service. Service can be done per hour. It's down to property, what you paid for. Insolvent means what? Means your assets minus your liabilities is equal to negative owner's equity. Your assets minus your liabilities gives you a negative owner's equity. In other words, if your liabilities are more than your assets, you're bankrupt. You're insolvent. Now, a non-business bad debt, we'll talk about that later, is deducted on Schedule D. All right, as a loss. It'll be a short-term loss. All right, but a bad debt, let's see, personal casualty loss is itemized deduction. For profit loss, all right, it's still itemized deduction, 2%. Loss is ordinary, limited to 20,000. But now, if it's a business loss on a Schedule C, corporation or partnership, that's where you put them. And that's called an NOL. What's an NOL? Net operating loss. Okay. Computed an NOL for individuals. Now we're going to look at NOL in this chapter. Now, usually, if a corporation has a $50,000 loss in 2017, I carry it forward. You can carry it backwards or forward. If you carry it backwards, you're going to go back and complete all those returns. So I carry it forward. Okay? And we got to look at those times. All right, I don't know what year they're talking about, probably 17. You can carry it back to 14, 15, and 16. So you can carry it back 3 years. And they should have just said that. You can carry it back 3 years. And forward, it's either indefinite or 5 years. See, I elect, when I do one, not to carry back, but only carry forward. It's a 20-year carry forward. All right, that's what this chapter is about, folks. Okay. All right. Now, what I'm going to do, I'm going to quit videotaping, and I hope you four that are out there heard what I said. If you got started late, the test grades were not great on this chapter. And I'll bring up Notepad, and there's the 5 grades, times 2, of course. There's a 23, a 26, a 24, a 25, and a 31. All right. If you times any of them times 2, there's 1 D and the rest are S. So what I'm going to do for all of you, because Hillary, when you take it, I'll scan it and I'll give you the same deal. Terry, Matthew, and Jonathan, anytime you can come in, Jonathan can stay late, probably Tuesday because he has intermediate, and I'll give you another hour on the test. As I explained a minute ago, if you got 26 right, you missed 24. That's the ones you're going to look up. If they have A, B, C, D part, and your answer, you put A and it's wrong, then you got 3 choices. So 1 hour to do 24 questions with 3 choices. So I'm going to cut off recording and get Clayton and Cole started. All right, read this chapter real well, and as always, start working even problems.